we're so used to living in a taxable world, you have no idea what's possible until you see it happen to yourself with your own eyes, when you can actually eliminate taxes from the equation and you see your strategies work over a period of time.
Welcome to the Power of Passive Income and How to Retire Rich with your host, Vijay Patel. Get your financial advice straight from the experts and learn how to take your first steps towards financial freedom. If you're ready to retire rich, then listen up.
And that's the other thing too, is that that's one of the advantages, I'll say, to retirement accounts in general, is that you're not, it's funny, when I worked in the Wall Street world, one of my mentors back then used to tell me, the death of the mutual fund industry is going to be the 1099, right? Because particularly if you have substantial assets and you start getting a tax bill every year, on money that you didn't actually receive, if you don't know what I'm talking about, that's okay. Here's the point, is that the advantage of retirement accounts is that you get tax protection on your income, profits, and earnings as you're compounding, like you're talking about. But we get to keep 100% of the money instead of any of it going to the various taxing agencies like the IRS or your state taxing authorities or those places. And so what that means to you and I is that we can exponentially compound our money faster and larger by erasing taxes from the equation. And I'll say that that's probably one of the most common pieces of feedback I get from clients, is that a few years into it, just like you're talking about, I'll get a call and they'll be amazed. They'll be like, have you seen the value on my accounts? And I'm like, and I've had some people actually be a little worried about it. I had one client specifically call me, I'll never forget. He lives down in Florida, and he called me one day. He says, dude, have you seen my accounts? He's like, I'm really worried. And I'm like, what are you worried about? He's like, well, I'm afraid I'm going to get audited. And I said, why would you get audited? Well, he said, have you seen my account balances? This is a gentleman who started with less than $100,000 when he opened up his accounts and transferred in. And here we are 3 years later. He's got multiple accounts with us, just to be clear, but the value of all his accounts had exceeded 7 figures within that 3-year period of time. And he said, I knew I would do well, but I didn't know I was going to do that well. And I said, look, we've talked through the investments. The things you've done are compliant, and they meet the regulations and they conform to the rules. I said, what you're observing, which is not uncommon that I hear from people, is that we're so used to living in a taxable world, you have no idea what's possible until you see it happen to yourself with your own eyes, when you can actually eliminate taxes from the equation and you see your strategies work over a period of time. To me, it still amazes me to this day. It amazes. The power of compounding, particularly in a tax-free or tax-protected environment, is just, it can accomplish amazing things.
Yeah, and again, going back to the same thing is taxes in general is 30%. So if you keep adding that $30,000 on $100,000, and if you again do a couple of cycles, that's another $100,000 in 3 years or 3 cycles.
Yeah, it adds up quickly, and that's why. Exactly.
Yeah. So, just a basic question, just for audiences, when we talk about retirement accounts, we are talking about 401s, IRAs. Is there anything else we are missing?
So there's a few different accounts out there. So I'll take a step back by saying I group accounts into 3 categories. Okay, so the first one is IRAs, individual retirement accounts. We're all individuals, so generally, right, we qualify to have one of those accounts. Then there's small business retirement plans. And for a lot of clients and a lot of people these days, they might have a side hustle. So they might have a W-2 job during the day, but they might be investing in some real estate on the side or doing something else. And so they, in many cases, qualify for a small business retirement plan. That's the second category. Those are your 401ks or solo 401ks, SEPs and simples, things like that. And then the third category is what we call tax advantage specialty accounts. And there's 2 key accounts that fall into that category. One is an education savings account, which is, I explain it, it's like a Roth IRA. If you don't know what a Roth is, we can talk about a Roth, but it's like a Roth IRA specifically for education. The health savings account is for out-of-pocket qualified healthcare expenses. Now, the way that I use those, and the way when we're working with clients that will help build these strategies, is that we look at the IRAs or the small business retirement plans, in other words, the retirement accounts, to create the lifestyle, right? However, what a lot of people are unaware of, and I'll never forget one of the earlier reports I read, this is going back into the 90s, when Ben Bernanke was still the Fed chair. He had written a report, and he talked about that the range for a retired couple, now this is, keep in mind, this is in the 90s, so these numbers could be a little different now, probably not to our favor. Yeah. He said the average married couple living 20 to 30 years in retirement is going to need $240,000 to $280,000 in out-of-pocket medical expenses over the period of retirement, even on Medicare. Well, here's the challenge. Most Americans don't have $240,000 set aside for retirement alone, let alone just healthcare.
Yeah.
So the way that I help clients build strategies is that we'll use that self-directed HSA to get one cash flow asset in there, because all the money comes out tax-free for qualified medical expenses. So you get one cash flow asset in there, just as an illustration point. Let's say it was a rental property. If it spun off $1,000 a month, you could use that money to fund your health care the rest of your life. Now that takes the pressure off the retirement accounts. We're just going to use that to create income streams to support your lifestyle, right? And so though looking at from a comprehensive standpoint helps us, I think create better results on the back end.
So just a small question is, like, let's say we are going after one property and like I have 4 different accounts like HSA, 529, 401 and IRA, right? And each just hypothetically has 200,000 in it. So can we all together go into one property and there is a way to combine it, or there has to be a solo investment into the same property, or it's not even possible?
Great question. So the answer is yes and no. So let me give you the no part first. So one of the accounts you mentioned was a 529. A 529 is a state sponsored plan, right? And they put the state sponsored plans like 529s, I liken to like company sponsored 401ks. There's a lot of restrictions. There's a lot of additional rules. Well, it's just restrictions that they put in place on participants, meaning they allow you to buy 5 to 10 mutual fund. That's it. So the no part is company sponsored plans, 529s, anything as sitting at a bank or a brokerage house. The answer is no, you can't do that. Generally speaking, right? However, self-directed accounts. So an IRA can be self-directed. A solo 401k can be self-directed, or a Roth 401k, Roth IRAs, health savings accounts, education savings accounts versus the 529. Could you take those accounts and partner them together into the same investment? Yes, you can. That is possible to do. So that's one of the ways that clients, I'll say my high net worth, higher income folks will do it, is that we actually will create custom plan designs, and we look at them as an individual. We look at their family situation, we look at their business situation, and we literally create a map of here's everything you qualify for, here's how you can fund it, here's what the numbers look like. And some people will implement that right away. Some people will implement it over time. Some people never have the resources to implement it fully, but they can implement what's most important to them, and they can prioritize, right?
Sure.
But what that enables people to do is get more money into accounts, have more money to work with in a tax sheltered area, and then be able to use all the money, even though it's sitting in different accounts. That's what I tell people, you can look at it as one bucket of money if you want to. So that's a huge advantage when you're able to self-direct your accounts.